Welcome everyone, and thank you for taking part in the advisory group's Pyramid of Success video series. As some of you transition into adulthood, or you're getting your career underway, or perhaps you're in a pivotal time where you need to look carefully at what the future holds, we feel that the tips and techniques we will cover here can help set the stage for you to work towards reaching financial success. We've created a series of 4 videos, each designed to assist you with understanding an important facet of the things that we believe you need to know to make your life easier and more successful. And we highly recommend that you view all 4 videos. So let me first start with some introductions. My name is Manny, and I'm a Senior Wealth Advisor with the Advisory Group. Also joining me is Brent, the President of the Advisory Group, and Chris Lee, the Vice President of the Advisory Group. All 3 of us are certified financial planner practitioners. Before we begin, it's always important to review that there are 5 key areas of financial planning. These are protection planning, retirement planning, tax planning, investment planning, and estate planning. Now, as a comprehensive financial planning services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. So during this series of presentations, we will be covering the 4 areas that you see highlighted there on your screen: retirement planning, tax planning, as well as investment planning and estate planning. Now, keep in mind, this is one of 4 separate videos that we have prepared, one for each of these subjects, so please be sure to watch all 4 videos. Let's talk first about the structure for your planning. This is what we refer to in our organization as a tag pyramid. It represents a structure with different levels of priority to potentially seek what you need. At the very bottom is the foundation. This includes the items you need to have in place and that we encourage you to satisfy: the estate documents, including the wills and healthcare directives, your insurance policies to protect your loved ones and hard-earned assets, and your home. Next up are your reserves, your emergency funds that you have to keep on hand, likely at the bank, for immediate access should the unexpected and costly arise. Now, this level of liquidity sacrifices potential growth, which again is why it can't be at too high of a level. Next up are your income-producing investment assets. These are considered lower risk than equity assets because of the fixed rate of return. These require your investment dollars, but have rates of return that aren't going to experience significant growth. Following this are growth and income-oriented investments. Now, you're taking on more risk by investing in equities and exposing yourself to the ups and downs of the stock market. Here, you may be investing in companies that have the potential to grow at an above-average rate, or those that pay out dividends but aren't going to experience significant growth. You then have growth investments. You're at a riskier level with your stock exposure, made up of the growth investments we talked about in the previous level, and now potentially adding international stocks with more room to grow. Finally, we have what we call the exotic level. This is one where we will not provide much guidance. Collectibles, precious metals, lottery tickets, cryptocurrency, they may all be nice to own and cross your fingers on, but we simply will not structure them into a financial plan or much less depend on them. Now, please excuse me, but I need to use an unpopular word here in the presentation. You need a budget. Now, all a budget does is determine where your funds are going. You have a budget whether you set one or not. And having a budget that you set gives you control over your own life. Not setting your own budget means that you are constantly having to worry about what your funds are going to be able to provide for you. A budget allows you to prioritize the money you have coming in and where the money you spend is going. Is your money going to your benefit or to someone else's? You first want to make sure that the things you need, your necessities, are covered. Next is the foundation that we have just discussed, as well as the reserves. Make sure that you and the people who depend on you are protected. As you plan for the future, you want to make sure you are prepared. Now, we will discuss this more a bit later. We're planners after all, and planning for your future is what we are focused on. And we want to make sure that you enjoy life, not just now, but for the rest of your life as well. By having a plan and following it, you know what you are able to accomplish and not stressed out every day by whether things will work out or not. Knowing what you can do and shouldn't do actually seems to provide a sense of freedom to be able to truly enjoy those things that you can do. Now, you may already be familiar with another famous pyramid, which is Abraham Maslow's hierarchy of needs. We are building here a little on Maslow's physiological needs of food and drink, shelter, and clothing. Now, we're assuming you're already taking care of the other physiological needs that Maslow listed: air, warmth, and sleep. Our basic needs are food and drink, shelter, clothing, medical, and transportation. Needless to say, these are our priorities for you. Yet too often we see wants being considered as needs. We hear terms such as "I deserve it" or "I need to relax." You've heard these kinds of statements. Whether it involves entertainment or partying or vacation travel or other actions, fixing up the home or car, the problem typically occurs when it is too much, too soon for your budget to support. Now, most people want to be financially independent. That is, they want to have the resources so that they don't have to work. Work becomes a hobby if you choose to continue to work. Instead of financially independent, let me use the more common concept of retirement. When folks retire, they typically have three likely sources of income to meet their obligation and discretionary needs in retirement. Now, when we say obligations, we're referring to bills and other required expenses. When we say discretionary expenses, we mean their wants, or those expenses that one can go without should they need to tighten the belt. Going to the movies, going out to eat, hobbies, etc. Think of this as a three-legged stool to provide financial support for people in their retirement. The first leg is Social Security. Despite headlines in the media, we don't expect the system to completely go away despite its depleting budget, because it is simply a public good that is too heavily relied upon. With that said, there are certainly challenges facing the Social Security system, so in all likelihood, actions are going to have to be taken. We may see the full retirement age increasing, or benefits may decrease. So, with savvy planning and preparation, Social Security does not have to be the primary source of one's income during retirement. The second expected source of retirement income is a pension plan. Once upon a time, pensions were quite common for workers who spent their career with one company, and upon retirement, they may have been given a fixed monthly pension for life. Those are more and more rare now, especially in the private sector. Most companies instead provide employee-funded pensions, primarily from salary deferrals, the most common of which are 401ks. So while workers are no longer tied down to one company for the purpose of securing that pension, the responsibility of setting up and funding a retirement pension has now been bestowed upon them. Your 401k can follow you wherever you go in various investment vehicles, or consolidated with future 401ks should the employer allow it. Now, the third leg is what you put away for yourself. It requires you to be proactive and direct excess cash flow towards your own private investments. There are various types of investments with different suitability features that are designed to help various needs. This is why when you meet with us, we ask many questions regarding your personal situations so that we know we're making appropriate recommendations. The Social Security system is, for most people, mandatory to fund. As for a 401k, once you flip the switch, your deferral should fund it automatically, and it requires minor diligence to keep moving forward. Now, many companies match a portion of your contribution to help you with your retirement savings. Private investments, however, require the discipline to save that excess cash flow and write the check to transfer those funds to the appropriate investment, knowing that you may be sacrificing short-term enjoyment for long-term prosperity. The key point from these sources is that you need to take care of yourself. Do not count on the government entitlement programs to take care of the bulk of your retirement needs. The sooner you're able to begin, the smoother the ride will be. One of the main costs in economics is known as opportunity costs. It deals with the opportunities that one bypasses by taking action in another. So if you're spending $300 a month golfing, as enjoyable and as happy as golf may make you, the opportunity cost is what you would have otherwise be earning and accumulating should you have invested that $300 into preparing for a successful retirement. Now, we're all for enjoying life, of course, but that's simply what the opportunity cost of that activity is. A common goal someone may have is to become a millionaire. Now, we've glamorized the term millionaire, but it's certainly achievable. Not just achievable, but perhaps even necessary for a reasonable retirement. If we look at the chart here on your screen, the earlier you make those sacrifices, bypassing a bit of discretionary spending and instead directing it towards long-term growth-oriented vehicles, the easier that it can be achieved. If you were to begin at age 20, which is not a small task for a typical college sophomore or junior, you would need to invest a fixed $285 per month for the next 40 years to reach $1 million in investments by age 60, assuming an 8% annual rate of return. If you do the math, $285 times 12 times 40 is only $136,800 that you've contributed. The power of compounding is an amazing phenomenon. Your earnings themselves yield earnings, and over time have the potential for such significant growth. Just $136,800 turned into $1 million. Now, if you were to get started late, perhaps because you weren't encouraged to invest or didn't have the cash flow to get started in such a disciplined plan, let's say you waited until age 30. At this point, you have lost 10 years of potential growth and compounding from our previous example. Here, you need to invest $667 each and every month to reach that $1 million mark by age 60. This is a factor of nearly 2.5 times more than if you had started out at age 20, and a grand total of $240,120 of total funding. Now, waiting until age 40, you only have 20 years to invest, and you'll have to put away $1,686 monthly for a total of over $404,000 in funding. And it just gets uglier the longer you put this goal off. Often the question at this point is, it all sounds great, but where do I get the money to invest? We all face spending temptation throughout the day. It's always easier to spend money than to save money, even for important goals. Many people like immediate gratification of their wants, so it takes a different level of mindfulness to really consider these long-term goals and how you need to potentially fund a retirement period that may very easily last 3 decades. So most people that have the ability and desire to begin investing on their own use the traditional method. They get their paycheck, taxes are withheld, they pay their bills and other monthly expenses, and they invest whatever is left, if any. Not surprisingly, there usually isn't much, if anything, left. They put investing last. So the method that we recommend to help build up the bulk of those assets earmarked for your retirement needs is to fund your planned investments first. As part of your needs, with a disciplined plan in place, you could set aside some or all of these funds before you pay taxes on them, thereby investing money that would otherwise immediately go to the government as taxes. Automate your monthly investing from your paycheck. Naturally, most people find it easier to live on the money they can touch. And oftentimes we hear, if I don't see it, I don't spend it. Use that to help you monitor your spending and still fund for your other goals. Now, we often hear that having credit is bad, and that is not necessarily the case. We recommend getting a credit card. If you're age 21 or older, you should be able to independently obtain one. But if you're younger, the credit card company may require your parents or some other adult to co-sign the credit card application. Why do we recommend getting a credit card? 2 reasons. The first is to have quick access to funds in an emergency. So if an emergency were to arise, having a credit card can help you get through that problem. And we generally like to say no one will lend you money when you really need it. So set this up before you have such problem. As our mentor loved to say, dig the well before you thirst. Now, a credit card can provide security in a financial emergency, but the second and key reason we recommend getting a credit card early is that, if used properly, having a credit card can help you build good credit history. But beware, the temptation to use a credit card can be seductive, and it's not uncommon for students to find themselves over their heads in debt before they've declared their majors. Unfortunately, a poor credit history can make it difficult for you to accomplish a lot of the things that you need to get a good start on your independent living, such as rent an apartment, get a car loan, or even find a job for years after earning your degree. Now, here are some tips that would help you use credit responsibly. You may want to get a credit card with a low credit limit to keep credit card balances down. Look for a card that has no annual fee, or at least a very low annual fee. Some cards will appear to have no fee, but in the fine print, the annual fee is only waived for the first year. Read the fine print and avoid this and other traps. Realize that a credit card isn't an income supplement. In other words, what gets charged is what's owed, and then some, given the high interest rates. If you find you continually have trouble meeting expenses, you need to review and revise your budget instead of pulling out the plastic. Now be sure to review each credit card bill and make the payment by the due date. Otherwise, late fees may be charged. The interest rate may go up if the account falls 60 days past due, and your credit history may be damaged. Don't carry a balance. Pay it off each month. Here's a little trap the credit card companies use. Normally, if you're paying off your credit card each month, you have a float when you charge something. In other words, the company is not charging you any interest on what you bought. But if you're carrying a balance, the credit card company may start charging you interest on a new purchase from the date of purchase. If you find that you can't pay the bill in full each month, try to pay as much as possible and then get it paid off as soon as possible. Notify the card issuer of any address changes so that you continue to receive statements if you're not getting them electronically. And finally, life on your own often involves student loan payments and maybe even car or mortgage payments. The less debt you have as you start, the better off you will be. When it comes to the plastic variety, extra debt is the last thing a college student wants to accumulate. Successful people manage their debt. They do not let their debt manage them. What is quote-unquote good credit? If you can get a car loan or a home loan at a very low interest rate, while setting aside the funds that you would have used to pay cash for, say, the car, you may be better off by taking the loan. What am I talking about? If you can borrow at this rate, it doesn't matter what that rate is, as this is just an example, and you can earn at this higher rate, you get to keep the difference in the two rates. And this is what banks do. They borrow your money in the bank account at a very low rate and then lend it out to people, say, at a very high credit card rate. Isn't this the reason that we said you never run a balance on your credit card? So borrow at a low rate if you can earn at a higher rate, right? Conversely, if you're earning at a lower rate, everything else being equal, you would want to take from your lower earning account and pay off the loan. Again, isn't the reason that we said never run a balance on your credit card? If your funds in the bank are earning less than the high rates of interest on a credit card, you want to use those funds in the bank to pay off the credit card balance. Let's use an example. Say that you can get your $20,000 car loan at 1.9% and your bank account is paying you 4%. Rather than pay cash for the car, put your cash in the bank and have the bank pay for the car loan each month. That 2% difference on $20,000 would mean you would have roughly an additional $400 per year in net interest earnings. If the rate on your bank account drops down to the 2% level or below, take your funds out of the bank and pay off the car loan. There are other concerns with using this concept. One is sometimes it is necessary to use loans to build wealth. Buying a home is often an example where we are likely to need to borrow money to get the long-term benefits of owning a home. Another example may be starting a business. The key is that you need to have a plan to make sure your actions will build your long-term wealth. And another issue is liquidity. In our example, if the only way you get the higher earning rate is by locking up your funds for a time, you may be taking on liquidity risks that can cause a potential disaster down the road. You may need to keep some of your funds in an account that looks like earning rate number 2 in order to have the liquidity to handle potential concerns such as accidents, weather conditions, etc. We always recommend having access to emergency funds even if they need to be in lower earning accounts. And we want to thank you for watching this video today. We've covered a lot today, and due to our limited time, we have had to condense various topics and discussion points. There are many factors to consider before you're able to properly evaluate your situation and determine the most appropriate way to pursue your goals. The advisory group is ready to assist you in determining your plan, coordinating it, and getting your path towards financial independence started. Those of you who already work with us know our first meeting is always complimentary, a chance for you to meet us and decide the course of action going forward. We appreciate this opportunity to share some ideas with you and hope that you found this series of videos enlightening and helpful. As you may imagine, we're in a heavily regulated industry and are very mindful of every bit of information we provide to you. So we have some discussions here. We realize your investment dollars are hard-earned, and so we and the regulators want to make absolutely certain that we provide you as much information as possible when making these decisions. And a second page of disclosures here. And a third page of disclosures. Now, please pause your viewing of the video if you need additional time to read any of these important disclosures in detail. Now, should you wish to set up an appointment with us to further discuss any areas of concern, not only based on this presentation, but as they pertain to your financial affairs, please reach out to us on the phone number or email address shown here on the screen. The best person on our tag team to set up a meeting with one of us is Katie Barrett. She is at extension 215. We greatly enjoy it when people have learned new information, so should you have questions, please feel free to contact us. Here is our contact information on the screen. This concludes our presentation. Thank you all again for viewing this video, and please be sure to watch the other 3 videos in this series.